Welcome to Section 6 of our ASC 405 Liabilities training series. This section covers two distinct but important liability topics: deferred revenue, which a SC 606 now calls a contract liability, and joint and several liability under a SC 40540. Both are frequently misunderstood, and both carry significant reporting risk. Let us get started. By the end of this section, you will be able to explain why deferred revenue is a genuine liability and not an asset, record and release contract liabilities at the correct time, classify deferred revenue between current and non-current, apply the recognition and measurement rules for joint and several liability, and identify the required disclosures for both topics under U.S. GAAP. Here is something that trips people up. When a customer pays you in advance, your first instinct might be to record revenue, but that would be wrong. Under a SC 606, receiving cash before you have delivered the goods or services creates a contract liability, also called deferred revenue. You do not owe that customer cash back. You owe them performance, and until you perform, you have a liability sitting on your balance sheet. The surprising part is how tempting it is to record revenue the moment cash arrives. It feels earned. The customer paid, why wait? Here is the key thing. Under accrual accounting, cash receipt and revenue recognition are two completely separate events. Recognizing revenue on cash receipt for multi-period contracts overstates income and understates liabilities. This is why a SC 606 explicitly created the contract liability category, to make the obligation visible on the balance sheet. Deferred revenue is measured at the transaction price, the amount received or billed from the customer. As you satisfy each performance obligation, that amount moves from the liability to revenue. Classification follows timing. If you expect to deliver within 12 months, the deferred revenue is current. Beyond 12 months, it is non-current. When a contract spans both periods, you split the balance and present it in two line items on the balance sheet. Let us make this concrete. A customer pays $120,000 for an annual subscription on January 1. On that date, debit cash $120,000, credit contract liability $120,000. No revenue yet. Each month you satisfy 1/12 of the obligation, $10,000. So each month, debit contract liability $10,000, credit revenue $10,000. By March 31, you have recognized $30,000 of revenue. The remaining contract liability is $90,000. Since all performance is expected within 12 months of the subscription start, the entire balance is current. The two journal entries for deferred revenue are straightforward once you understand the logic. Receiving advance payment, debit cash, credit contract liability or deferred revenue. As the performance obligation is satisfied, debit contract liability, credit revenue. The key discipline is releasing only the portion you have actually earned. If you delivered half the services, you recognize half the revenue. Track each performance obligation separately, especially when contracts contain multiple deliverables. Watch out for this one. Joint and several liability is not the same as proportionate liability. Under joint and several liability, each party is independently responsible for the full obligation. If your co-obligors cannot pay their share, the creditor or regulator can come to you for the entire amount. This concept appears most often in environmental remediation cases where multiple entities contaminated the same site, in loan guarantees, and in partnership obligations. Here is the key thing about joint and several liability recognition. You record the full obligation on your balance sheet, not just your agreed share. Then, separately, you recognize a receivable asset representing the expected contributions from your co-obligors, but only if their payment is both probable and reasonably estimable. Before you recognize that asset, you must assess each co-obligor's financial ability to pay. If they are financially distressed, You cannot offset their share against your liability. Let us walk through the first scenario. Three entities are jointly liable for a $3 million environmental cleanup. Each has agreed to pay 1/3. If all three co-obligors are financially sound and their payment is probable and estimable, you record the full $3 million liability. You also record a $2 million receivable from your co-obligors. Your net balance sheet exposure is $1 million, your agreed share. This is the only scenario where you can net down the gross liability. The surprising part is what happens when your co-obligors cannot pay. Same facts, $3 million cleanup, three parties, 1/3 each. But now your co-obligors are financially distressed and unlikely to contribute. You cannot recognize the $2 million receivable. The full $3 million liability stays on your balance sheet with no offsetting asset. You absorb the full expense. This is why assessing co-obligor financial health is not optional. It directly determines your reported liability. The third scenario sits between the two extremes. Your own agreed share is clearly determinable, and you have strong evidence the co-obligors will fund their portions. In this case, you may recognize your own share, $1 million, as the minimum liability, less any amount certain to be funded by others. This is the least common treatment and requires high confidence in co-obligor performance. Even here, you must still disclose the full $3 million obligation in the notes. Both topics carry specific disclosure requirements. For joint and several liability, you must disclose the nature of the obligation, the total obligation amount, the amount recognized on your balance sheet, and the amount attributable to co-obligors. For deferred revenue, you must describe remaining performance obligations and when you expect to recognize them as revenue. These disclosures give financial statement users a complete picture, the gross exposure, not just the net balance. Let us bring it together. Deferred revenue is a genuine liability. Cash in advance means you owe performance, not just money. Release the contract liability only as you satisfy each performance obligation. Classify the balance as current or non-current based on when delivery is expected. Joint and several liability means the full obligation goes on your balance sheet, regardless of your agreed share. You can only offset for co-obligor contributions if their payment is probable and estimable, which requires a real assessment of their financial health. Thank you for completing this section on deferred revenue and joint and several liability. Thank you for watching. Subscribe for more training from PNJ Group.